prices moved up so much, and a lot of those places had a lot of institutional buyers, and they've pulled back now, Kessler says. Real estate investors looking to make large-scale profit from buying single-family homes and flipping them, often referred to as iBuyers, in many of the most popular markets have slowed business or stopped altogether. What's different from the 2008 housing market crash? Homeownership can feel scary during any point of economic uncertainty, especially if you have a vivid memory of the Great Recession and the housing market crash of 2008 and 2009. Predatory lending practices in the first years of the 21st century meant many homeowners faced foreclosure when adjustable interest rates rose, and unemployment further increased the number of properties in foreclosure. Housing demand was artificially propped up by issuing mortgages to people who weren't in a good financial place to buy and maintain a home, and the economic downturn also meant buyer demand plummeted. Home values declined significantly as a result. The current situation is very different compared with the Great Recession, says Rick Schager, Executive Vice President of Market Intelligence at real estate data company ATTOM, based in Irvine, California. Mortgage delinquency rates are actually lower than they were prior to COVID, he says, noting that 2019 was in itself a mild year for foreclosure activity, historically speaking. 93% of borrowers who are in foreclosure today actually have positive equity in their homes, which gives these distressed homeowners a couple different options for a soft landing, Schager says. Reynolds points out another major difference between today's market and the housing crash is the issue of supply. Excessive building leading up to 2008 meant that when demand dropped, there were entire housing developments that sat vacant. Cut to 2023, housing is still catching up on the low rate of building compared to household formation since the Great Recession. There are fewer homes per household than there was back then, Reynolds says. With today's homeowners, laws and regulations have been in place to prevent predatory lending since the Great Recession. Even as high home prices and rising interest rates have increased the total cost to buy a home, making homeownership unaffordable for otherwise would-be homebuyers, there are still more qualified buyers searching for homes than there are properties for sale. All these factors combined, and Reynolds says he and his colleagues agree that a crash at this point is unlikely. Building permits are down, but housing demand isn't as of January. The U.S. Census Bureau's Building Permits Survey reports there were 53,100 single-family building permits filed in the U.S., far below the forecast of 64,000 permits predicted for that month in the U.S. News Housing Market Index. Still, it's well above anything compared to the Great Recession. After the housing bubble burst in 2008, building permits for single-family detached homes cratered to a low of 22,100 in January 2009. In a typical year, the number of building permits bottoms out in December and January, then steadily climbs until peaking in the spring and summer months. U.S. News Housing Market Index forecasts a peak of nearly 77,000 building permits in March 2023. Compare that to March 2022's peak of 107,400, which was also the highest month for number of building permits filed in all of 2022. With far fewer permits already, expect new home construction to slow. Builder sentiment is also down to 42 out of 100 as of February 2023, a steep decline from 84 in December 2021, but a month-over-month increase from 35 in January 2023, according to the National Association of Home Builders and Wells Fargo Housing Market Index. Builder sentiment is based on the number of new single-family homes, predicted single-family homes in the next 6 months, and overall traffic of buyers. In short, builders don't feel like they're going to be building many new construction homes for the foreseeable future. But that doesn't indicate the housing market is going to crash or that a new housing bubble will occur. In fact, they may be helping to avoid future problems. Incredibly limited supply is keeping a floor under prices. That shows sellers are really willing to hold on to what they've got, Tucker says. That does kind of prevent runaway declines in prices. How does a recession typically impact the housing market? At least 2 consecutive quarters of negative GDP growth make a recession, and it's typically accompanied by an increase in unemployment and decrease in consumption by the general public. The financial strain individuals face during a recession leads to a slowdown in the housing market. Homebuyers may pause their search if they're worried about layoffs, and there may be a slight increase in foreclosure activity, while higher unemployment increases the number of people who can't pay their mortgage. However, once activity on the housing market slows enough, mortgage interest rates drop to a point where buyers re-enter the market, interested in getting a good deal. Unlike in the Great Recession, an increase in housing market activity helps to bring the economy out of recession. The real GDP increased in the last 2 quarters of 2022 by 3.2% in the third quarter, and 2.7% in the fourth, according to the Bureau of Economic Analysis. Additionally, unemployment remains low at just 3.4% in January, according to the Bureau of Labor Statistics. While these indicators show no recession right now, the Fed's actions throughout 2022 lead most experts to agree that a recession is likely in 2023. I think it's going to be a short recession, but it's going to be a recession, Kessler says. What conditions could lead to a housing market crash or housing bubble burst? While current conditions don't point to a housing market crash, there's no crystal ball to guarantee how the economy will fare in the next few months or years. A few factors that could make the housing market more unstable include unemployment. A slight increase in unemployment would be okay, but a bottom fallout could be an indication of danger for the housing market. If too many people are without work, then distressed home sales climb and foreclosures become more likely. Home building. Builders have been plagued with labor shortages for a decade, and the availability and cost of materials have been an ongoing issue since the start of the pandemic. With the slowdown in buyer activity, home builders are pulling back and there are fewer permits for new housing construction. That can prolong the housing shortage, drawing out the demand-supply imbalance. Buyer demand. Housing markets have cooled slightly, but demand hasn't disappeared, and in many places remains strong largely due to the shortage of homes on the market. If buyer demand completely disappears, it would be a sign of a problem. Homebuyer motivation. For the typical homebuyer, now is not the time to buy real estate with the expectation of seeing value double in a short period of time. Kessler advises buying with the plan to live there for at least 5 years. If you can afford to live there, don't worry about the noise between now and then, Kessler says.